In our last segment, we calculated the P&L in steady state. So we took together all the revenues and the direct and indirect cost that we will have in steady state to calculate the operating profit. With this exercise, we were able to answer the question, is our business idea profitable? With our next exercise, we want to answer a different question, and that is, how much money or how much investment do we need to get the startup running? In order to do this, we start again with the P&L that we already created, but now we will replicate this exercise for each period, starting again at steady state, moving backwards all the way until today. So we will end up with a series of P&Ls for each period between now and our steady state. Now, if you do this, typically in the first P&Ls, you will have no revenue and so no directly related cost either, so also your gross margin will be zero. However, you will have some indirect cost. So overall, in the first period, your startup will turn an operating loss instead of a profit. Now, this indirect cost could be research and development cost for your product, it could be starting salaries for early employees, or maybe the rent for your office space. As you move along in time, there will be a point when you start generating some revenue and have some directly related cost, so you also have some gross margin. And again, you will have some indirect cost, and you will get to a result as well. At some point, you will break even, which means the revenue and the sum of all your cost is the same, so your operating result will be zero. And then as you move along, you will start turning a profit. Once you have the series of P&Ls, we will make one important simplifying assumption, and that is that all the revenue and all the cost are directly cash related, which also means that all losses and profits for each period are directly reflected in your cash. Now, to calculate the cash level, we will start with the amount of cash that you have today. That can either be zero, or if you have some amount of cash either from your own funds or from friends and family, you will put this starting budget in this column here. And then, as you move along, you add the operating loss or profit to this number to get to the cash level at the end of the period. And you'll repeat this for each period until you reach steady state. This will give you a series of cash levels, which is the way that your cash develops over time. Now, typically for a startup, this cash curve looks something like this. You start with some amount of cash. In the beginning, you turn losses. At some point, you break even, and then you start generating profits. Now notice that this line goes below zero. So that means that you need cash to get this company going. How much? Well, just look at the lowest point of this graph. This will give you the amount of cash you need in total to get the startup up and running. Now, if you successfully manage to raise this amount of capital, either from investors or from other sources, your new cash curve will look something like this. Notice that again, it starts with the amount of cash you have now. The cash goes down. At some point, you reach an agreement with investors or with other sources of capital. You get a capital injection, and then the curve follows the same movement, but very important. Now, the second line never goes below the line 0, so it's never negative. That is also the most important rule for a startup as you manage the growth of your company, and that is never run out of cash. Why is this so important? As soon as you do run out of cash, or in this graph, as soon as your cash line goes below 0, you will not be able to meet your financial obligations, and most likely you will have to close down your startup. So let me repeat, the most important rule as you manage the growth of your startup financially is never run out of cash.